Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for September 2nd, 2018. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.22 rose from 1.11 last week. The total count of securities in bullish or bearish patterns increased 1% to 3,057. The count of bearish stocks decreased 4%, while the count of stocks in bullish patterns increased 6%. The Pirls P&F market breadth summary chart shows us a market 2 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 138 points for the fourth advance in 12 weeks. At a positive 287.22 points, it has risen above the March 2018 and July 2017 tops and continues below the 6 remaining tops above plus 100 in the last 30 months, and it continues above all 4 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in accumulation mode on lower average daily volume. Momentum. The CCI 20 daily at a positive 160.18 rose from a positive 130.02 last week after forming a Woody's zero-line reject long entry signal at Thursday 8:16 close in a continuing Woody's uptrend. We will follow this trade simulation in next week's commentary and will exit if the CCI 20 daily falls below plus 100. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 122 weeks ago, while the daily CCI 20 began a Woody's uptrend 7 weeks ago. The CCI 20 weekly rose to 140.60 from 98.96 last week, continuing outside the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: some tech and S&P retail on top. Banking and some tech on the bottom. Bullish, networkers, and S&P retail continue in the top 5. Comp tech has left the bottom 5. Semis, disk drives, and comp tech have entered the top 5. Oil has left the bottom 5. Bearish, gold and silver has left the bottom 5. KBW Bank and computer hardware have entered the bottom 5. Focus this week from www.realinvestmentadvice.com by Lance Roberts. Weekend reading. Are emerging markets sending a signal? The following are some key points and charts. I have been and remain bearish on emerging markets for 3 reasons. 1. As discussed yesterday, the U.S. is closer to the next economic downturn than not. When the U.S. enters a recession, emerging markets are hurt considerably more, given their dependence on the U.S. 2. International risks in countries like Turkey, Greece, Spain, France, Italy, etc. 3. A strong dollar from flows into U.S. Treasury bonds for a, quote, safe haven, end quotes. I recommend in January of this year to remove all international and emerging market exposure from portfolios, and have been updating that position since each week in the newsletter. Quote, emerging and international markets were removed in January from portfolios on the basis that trade wars and rising rates were not good for these groups. With the addition of the Turkey crisis, ongoing tariffs, and trade wars, there is simply no reason to add drag to a portfolio currently. These 2 markets are likely to get much worse before they get better. Put stops on all positions, end quotes. This has been the right call, despite the plethora of articles suggesting the opposite. My position is simply that the economic dependency of emerging markets on the U.S. is extremely high. Therefore, when the U.S. gets a cold, emerging markets get the flu. Over the last 25 years, this has remained a constant. While the markets are currently dismissing Turkey, Brazil, China, and Russia as non-events, the problem is the issue of funding needs for these countries. What happens if this outside capital inflow stops, or worse, reverses? This is where things get dicey. To answer that question, Morgan Stanley has created its own calculation of emerging market external funding needs and defined it as an external coverage ratio. It is calculated by dividing a country's reserves by its 12-month external funding needs, which in turn are the sum of the 1. Current account, 2. Short-term external debt, and 3. The next 12 months' amortizations from long-term external debt. Given the ongoing pressures of tariffs, trade wars, and rising geopolitical tensions, the risk of something going wrong has become increasingly elevated. Yet, market participants are ignoring the risk simply because prices are rising. Emerging markets are likely already signaling there is an issue from the Federal Reserve's actions, and the consequence historically has not been good. But, as I quoted yesterday, quote, unfortunately, Powell left the unsettling feeling that monetary policy can be summarized as we plan to keep hiking until something breaks, end quotes. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. For Santu Pirls Stock Market Commentary, I'm Cynthia Pearl, hoping that you are enjoying a peaceful and pleasant Labor Day weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.